Welcome to the Monopoly Mindset, the podcast where we uncover the strategies to build your real estate portfolio one property at a time.
We're your hosts, Tyler and Tommy, here to share our story of playing real-life Monopoly.
Whether you're just starting out or a seasoned investor, this is your go-to resource for mastering the real estate game.
So grab your board, roll the dice, and let's buy Boardwalk together.
Welcome back to the Monopoly Mindset, episode 35. We have a great episode today. If you've ever wondered how to buy rentals without showing your W-2 income, this episode's for you. Our guest today is a Misericordia alum where he played soccer, was also a previous tenant of mine, and now he's a top account executive with Burr.com. Welcome, Dom Pizzi, to our show.
Thanks, guys, for having me. I have a pretty good resume, I guess, huh? Out of all that list.
So
it's one of my favorites for sure.
You lived with Tommy. Was that your first rental, Tommy, or your first house that you bought out of college?
Yeah, it was the first house. It was 267. He lived there. I think the second group of kids that went through. I think I had soccer girls first, and then Dom was the second group, the first group of guys that went through there.
So you owe Dom a lot of credit for the amount of houses that you bought up there. He was the proof of concept.
Yeah. Dom was the proof of concept. And ironically, on our last podcast, we were talking about 267 and be interested to get your opinion on this, Dom. For whatever reason, that house gets the most requests from kids to rent it out. Like I've been contemplating selling it. I've also contemplated refinancing it, which we could get into later. But I don't know what to do with it because I kind of want to sell it. And like every year, that's the first house I get a text from. It's like, hey, we want to move into 267. Like we like that house. And like, to me, I think it's too small. I'm like, I want to get a bigger house, but like the kids just seem to like the vibe there.
Yeah, I don't know if you want to hear this, but like it's a nice little hangout house. You know, you have like the 4 bedrooms, the basement, a pretty decent sized backyard, and the carport too, where you can kind of just like hang out and chill. So it makes sense, and plus it's kind of close to campus. Like it's only like what 3-4 minutes tops. So like to me, it's a no brainer. At least I would keep that if it were me. But
So why don't you start out and just tell us a little bit about your background and Burr.com and how you ended up working there, and like was real estate always kind of a thing on your mind, or loans?
yeah, so I guess this is kind of like a thing by fate. But I went to school at Misericordia to be a physical therapist. Kind of went in there thinking that was going to be the end all be all. I was playing sports, I was going to classes, had a great GPA, had great teachers, on all of that stuff. And by the time I graduated, so Misericordia's undergraduate uh, degree for the physical therapy aspect, you need to get it done in 3.5 years. So I got the 3.5 years done, and I went to 3 days worth of graduate school classes, and I realized that I absolutely hated physical therapy, which is kind of horrible considering that you like think your whole life like this is exactly what you're going to do. So I switched out of the PT program. I went back and I got my master's done through Ms. They were able to get me into like their 4+1 program. So I got that done instead. But all the while, at least for us, we were going to school as juniors and seniors during COVID. So during COVID, you really weren't doing much other than like your like general schoolwork online and then maybe just like staring at the stock market. And to me, like that interested me more, the finance perspective of it interested me more than like doing PT and like doing like anatomy and physiology and all of that stuff. It didn't really appeal to me anymore. So on top of that, people were preaching, how important real estate is to the finance aspect of how, you can be financially free by just having a couple of rental properties. And everybody makes it sound so easy, and it kind of is, as long as you have like a good team and, you kind of know like generally what's going on with real estate stuff. So I started realizing I was focusing more on those things. And when I got out of school, I didn't have any internships lined up because obviously during COVID, it was very hard to get those internships. Um, So I was kind of like calling around to see, who would be able to like basically take me on as like an entry level employee with no experience. Um, and that's when I met my boss, Joel. And I've known Joel since I was 8 years old. Actually, he used to drive me around to soccer tournaments because his son and I used to play on the same team. And he is very good friends with my dad, who actually used to personal train him back in the 80s. So it's a little bit of a weird, I guess, like coming together story. But he called me and was like, "Listen, this is what we do. We're a private lender. We help finance real estate transactions for people that are purchasing rental properties, doing like fix and flips, things of the nature." He was like, "Why don't you just come and try it out, see if you like it? No harm, no foul if you don't." And I came in for like 6 weeks, ran through a training program, and I'll be here actually for 3 years next week. So kind of a cool little like all together wrapped up story of like where I started and, kind of where I'm at least today.
Well, congrats on 3 years. That's
Thank you.
impressive in
I can't
any
believe how quickly
industry.
time went. That's actually even more insane to me that it's, hearing that out loud. But
Ty and I just celebrated wedding anniversaries. Mine was for 5 years back in June, and Ty just had his a couple weeks ago or a couple days ago for 4 years. And like both of us said the same thing is that it felt like it was yesterday. And I'm sure for you, it feels the same way with starting
yeah,
your career.
absolutely.
Your story seems like every podcast that I've listened to, or like seems like every entrepreneur has like a very similar story of like I either graduated college and got a job and hated it, or like you were in your major and just like you graduated and then you decided then you hate it. And like we had our last guest was an engineer. He did it for a year, just quit and was like I can't do this. And it like I'm wondering if like not picking like a major and then going into a job that you don't like kind of pushes you towards like entrepreneurship and investing, or if it's just kind of always there and that like no matter what career major you decided you kind of would have wanted to go that route. I don't know, just thought about that, but yeah,
I
it seems
think
like
uh, I think at least from that perspective, you need to have like an entrepreneur needs to have like a specific drive that some people just simply don't have. Like some people need to work that 9 to 5 every day, and they need to have that set schedule. Like an entrepreneur, you're putting more time and effort into those things than maybe somebody that is on that like set schedule. But even when I was in school, they would always say that the statistic is that less than, I think, actually, it's more than 50% of the US doesn't go into the field of work that they got their college degree in. Um, I didn't want to be a part of that statistic, but it turns out that that's just how it happened. But I kind of see that as a positive too, right? You do something that you enjoy doing as opposed to, getting up and going to work and not enjoying it. So it doesn't really feel like work in that aspect, if that makes sense.
I think it's so tough to have kids that are what 15 to 18 and have to pick what they want to do for the rest of their life. And like in
Agreed.
Dom's point, getting into PT seems really cool, especially as a kid. You're like, hey, I want to help people that are injured. I want to like help them get back to normal. It's a good job. But then when you start studying certain science courses, you realize, hey, I don't care this much about science as much as I want to help people. I want to figure out a different way to do it. And it forces you to dig deep and think about other things and like naturally you learn to investing and like the main goals in everybody's life part of it is to make money, right? Like you have to make money to support yourself, support your family. And you were kind of studying that and adversely found yourself in this job, gave it a try, and ended up discovering that you had a big passion for helping people get into real estate portfolios and learning more about real estate. So I think it's a really cool transition on, your story.
Yeah.
so. Why don't you tell us a little bit more about Burr.com? So we've said the word Burr probably every single episode. We've talked about different types of financing between like residential and commercial, but I know Burr is like specifically, I know you guys have DSCR and bridge loans, but can you kind of go in depth about like each product and maybe, yeah, just a little bit about each one?
Sure. So at least from a general perspective, the BRRRR strategy is obviously very, well known in real estate investing. And if people don't know what it stands for buy, renovate, rent, refinance, and repeat. That last R is obviously the most important. If you want to build the portfolio, you're obviously continuing that process. There's some people that tend to do the whole burr strategy in full. There's some people that like to just do the buy and renovate and flip aspect of it. So we would call that a fix and flip loan. Some people just like to buy rent ready properties that have that day one cash flow opportunity in it. That's where those DSCR loans would come in. So, from a fix and flip perspective, so kind of starting at step one, when you're identifying a property, essentially somebody's looking for something that needs a little bit of TLC, needs to get a kitchen redone, floors need to be ripped up, needs new paint, something along those lines, right? You're adding value to the property, but you're also getting it at a price that isn't like ready to go in that aspect. So you're buying a distressed property, you're putting X amount of dollars into renovations, and it's obviously where, experience and having a good team is going to be important. You'll need to have a good contractor to be able to get you, good numbers on what the work is actually going to cost. Um, or you need to be able to be capable to do it on your own. Um, so at least for those fix and flip loans, you're buying one of those distressed properties. Those loans are very short term, so you have 12 months to do it. They're interest only in nature. So when I say something like that, you're not paying like the principal, interest, taxes, insurance, and association fees that you would be paying on a DSCR loan. You're only paying interest on what you use. So my general example on that is give somebody a $40,000 renovation budget and they fund the whole thing out of pocket. Some people like to have that flexibility to be able to do that. Um, if they don't touch the $40,000 budget that we give them, they're not going to get charged interest on stuff that they don't use. So that's kind of like the beauty, at least, of that fix and flip loan. And a lot of private lenders, or like I guess like institutional lenders, we can call them, have that loan option. So from the fix and flip perspective, you can either stop at the flip and say, hey, I renovated the property and I want to get rid of it. People just put it on the MLS, they'll sell it in 30 days and they'll wipe their hands and they'll move on to the next project. Then there's the other half of people that decide, hey, I'm actually going to hold on to this in my portfolio. What would be the next steps? So the next step from there would be to get a tenant in there, and get them a lease for at least 12 months. This can be either just a general tenant that you screen through Zillow, could be a Section 8 tenant, can be whatever you feel as though is necessary, from that side of things. Always want the lease to be at least 12 months, usually backed up in your bank statements by first month's rent and security deposit. And then if you plan on holding onto the property, we can get you into a long-term loan through refinance through that DSCR avenue. So DSCR, just for general purposes, stands for debt service coverage ratio. And basically, the property is considered lendable to a lender if that ratio meets 1 to 1. And what I mean by that is if the rents of the property outweigh the costs of the property. And the costs would be just principal, interest, taxes, insurance. And then if it's like a condo or a townhouse that has an HOA, any association fees. So PITIA would be the bottom of that, fraction when you're doing your calculations. As long as the property is considered 1 to 1 in that ratio, it's considered lendable, and we can start that refinance process. We'll get somebody into a 30-year fixed um, mortgage within 30 days of starting that process, and then ultimately those cash out proceeds would be then used to kind of repeat the process over and over. So, typical burst strategy all the way through and through.
So correct me if I'm wrong, but interest rate on the DSCR is kind of based on a few things, but the ratio is a big one, right? Like a 1.1 is going to have a worse rate than like a 1.5 or 1.8 because there's more buffer there. It's more
Correct.
risk if they have less cash flow, basically more risk to the bank. And then obviously like credit score. I guess you still do a credit check even though you don't do like W-2 income. You don't really need W-2 income. And then I'm assuming loan to value kind of could be another factor.
Yeah, so a lot of the DSCR variables that's going to come into play of an interest rate is going to be FICO score of the borrower. So I usually have different buckets for FICO, and they'll have different loan level price adjusters when it comes to like figuring out what the final interest rate's going to be. So that FICO score, the property type, that DSCR ratio, whether it's like 1.0, 1.1, 1.2 and higher, whatever the case may be. Some states have specific price adjusters as well. The loan amount as well. So like obviously a higher loan amount is going to yield maybe a lower interest rate as opposed to like a $70,000 loan to probably yield a higher interest rate. So a lot of that stuff is going to play into the interest rate portion of it. And then also the transaction type too. Like if you're purchasing property, you're gonna have less of a hit than like a cash out refinance. But people tend to offset that by taking lower LTV buckets. So instead of pulling out the maximum on a cash out refinance, which for us is 75%, they'll take like 70% or 65%, and they'll take the lower interest rate and less cash out of pocket in order to keep that buffer on a cash flow perspective. Because I know like certain people like to have certain amounts that they need to make every month in order to make the rental make sense, right? Like $500 sometimes is like a usual number. But also kind of just want to make a point too that even though the DSCR is only calculating those five variables, like a lot of people tend to forget that there are obviously other costs that are associated with owning a home. So you kind of need to add in those utility payments, like electric if you're paying for it and it's not the tenant's responsibility. Um, any kind of like operating expenses, like God forbid, let's say like your boiler goes, like how much is that going to eat into my cash flow for the year? So there's other things that you kind of have to take into perspective on that cash flow side of things as well. But just for like a general perspective of calculations wise, those are really the only five things that we're taking into account there.
Yeah. So I've done one burr and I've used DSCR. I kind of screwed myself. I don't even want to tell you what my interest rate is, but my ratio is like already pretty low. Like the cash flow is not great. But I didn't care because I was like, as long as I can get more money out, then I'm leaving less money in, and ROI can still be higher if you don't leave as much in. So like as your LTV goes up, then your ratio goes down because your monthly payments going up. So I was like super close to like 1.1. My ratio is, or my interest rate's terrible, but it was my first investment deal ever, and I'm just learning. But one thing I wanted to point out, and correct me if I'm wrong, but DSCR is always a little bit higher than if you just go buy an investment property under your name, and go like a commercial loan. And I don't know if maybe it's like 0.25 to a 0.5% higher, but I will just say from experience that one of the biggest benefits I see from it, obviously, is the no W-2, like because people say that you get to a point where you buy enough rentals, you won't get approved for um, like a federal loan or whatever, a conventional loan.
Conventional, yeah.
So that's obviously a huge benefit. But honestly, the biggest is just how much easier it is than going through a conventional bank. Like I've done three conventional loans and one DSCR, and like the DSCR is just like two documents. They're like, all right, you're good. They can do it in like 14 to 30 days. Conventional is the complete opposite. You go back and forth 50 times. They constantly say like, "Oh, these are the last three documents that we need." You send them those three. 2 days go by. Oh, we need these six more, and it's just like a constant headache. So, obviously, if you do like one deal a year, maybe you go through that headache to save point, 0.5%. But as you grow and you're starting to do more deals, let's say you're doing like one a month, I never would want to deal with a conventional bank once a month. I would much rather just save the hassle. Even if I'm taking a little bit of hit on interest rate, it is just, at least my experience is it's just 10 times smoother, quicker, easier to go DSCR.
Yeah, so I guess I'll give you like a general pros and cons of kind of what I see, at least from people that call in and they'll ask questions. So from the DSCR perspective now, obviously conventional lenders can offer that product as well as the privatized lenders. Conventional, yeah, of course, you're gonna obviously get that lower interest rate, but you're gonna have to jump through more hoops in order to get it. There's more documents, so you're gonna need tax returns, so you need to look good on paper. Um, need to have good FICO score. Debt to income ratio is going to be very, very important over there. On the flip side for us, yeah, the rate might be a little bit higher. Maybe sometimes not. Sometimes there is an overlap where the rates are generally the same. Between us, maybe a conventional lender. But the beauty about going to like an institutionalized private lender would be, um, the loans that we do from a DSCR perspective, they don't show up on your credit report, so they don't bog down your DTI. Um, the only thing that is going to make it show up, obviously, is if you don't pay, and that does happen. Um, we can close in the name of an LLC or in your individual name. So throughout that, refinance process or purchase process, we'll get your entity documents together. And from a liability perspective, you're a little bit more protected when you hold title in an LLC or a corporation in comparison to having all of it under your individual name. So that's the beauty of it on that side of things too. Speed is obviously one of the big ones too. We can get those loans done in 14 to 28 days. Our average is about 24, at least on my end. Whereas a conventional lender might take 30 to 45. They might ask you for the same thing 3 or 4 times. They have an underwriter that they're asking those questions to every single day in order to approve the loan. So from a DSCR perspective and like from a privatized perspective, yeah, you might pay a little bit more on the interest rate, but it's really more about like the speed and the smoothness of the transaction more so than it is about jumping through hoops in order to save a quarter a percentage of interest rate. I don't know. I would rather have less questions as opposed to try and save the additional dollar amount. Like $30 a month in cash flow is not going to help me as much as people might say it might, you know?
Yeah, and a huge call out that you mentioned is just like the speed. And there's, like you say, not looking good on paper. And like TDJ, for example, is a company that looks horrible on paper. Typically most real estate investors don't look good on paper because we're always trying to get as many tax write offs as we can or save in taxes. And so for a real estate investor to save in taxes, I'm saying, hey, I had to replace the roof. Hey, I had to replace the furnace. And I'm putting in all these little expenditures, all these meals of going out to eat, everything that I can do to write off how much money I've made to make it look like I didn't make much money so I don't have to pay that much tax. I'm depreciating the asset. Like I'm doing whatever I can to not pay taxes. But when you do all that, you look bad on paper. And so then I've dealt with several banks and like TDJ had a big issue looking bad on paper, going to bank after bank after bank, and they did not want to do business with us. And then we go to Burr.com, and it's a completely different dynamic because you weren't standoffish with us being an LLC. You were very happy to deal with us there. And our paper trail of like, hey, we don't look great on paper to a traditional bank. We were making a ton of income. So to you, we do look really good on paper. Like the properties that we were buying were cash flowing. So it was, very very enjoyable process, for a real estate investor to go through like with Burr.com. And I think Ty made this point earlier that there's so many different like issues with real estate investors going through commercial banks because once you get to like that 5 to 10 mark, like really after 10, you can't really get any more loans. So you're going to have to start going down this DSCR route eventually. And so the earlier that you start going down it, I think the more experience you can build, and like Ty and I've talked about this a ton, is like you start building relationships, and now, okay, Dom's got like my file on standby, and he knows exactly what I'm looking for. He has a general idea of what he's going to need from me. I have a general idea of what you're going to ask for, and then the speed, you can just hurry up that process and move much quicker, throughout the loan process. So I think there's a ton of value to going this route.
From a DSCR perspective of, you know, going to like certain banks, you obviously have that cap. With us, it is more relationship driven, where it's going to be a lot quicker, especially if you're using the same LLC. You have the same guarantors on the deal. If all of the deals kind of look, say similar to one another, right? Like you can anticipate what the numbers are going to look like, so that you kind of know firsthand what you're expecting when an appraisal comes back, or if a title report comes back, that kind of thing. Um, the speed portion of it is going to be a big thing, right? Because especially on a refinance side, people might be ready to roll those funds into something else that they found when you're on like day, let's call it 7 of the refinance process. Well, it's like, well, now I need to close on this property within, let's say 24 days. Like, can I get those refinance funds done in an ample amount of time so that I can use them to go either purchase or use as a down payment on this other property? Like the
And
short answer,
something that could get missed even for me, like I'm primarily buying student rentals, and that's something you constantly bring up is like, hey, this is another student rental, right? Because we have to go this way or that way about getting that property, or using like so. That's again something that us working together relatively often is something that you know to bring up if that is the way that I'm purchasing or not.
yeah, and I think there's like a level of, let's call it transparency, I guess, between your clients and you, because I would much rather you tell me exactly what I need to know up front before I find out about it down the line. And like I can give you countless examples of like people trying to hide things and like making sure that like maybe we don't catch it. Like the truth is always going to come out. I hate to be the bearer of bad news there, but at least from like an underwriting perspective, like my team and myself are trying the best that we can to mitigate as much risk as humanly possible right from the get-go, so that this way we know what to anticipate when it comes to fully underwriting the loan. And when they ask us questions, we already have the answer. We're not going back to the client saying, oh, what's this, and this. Like it should be a very smooth process. But every client is different too, like Tom, you focus on student rentals, but Ty might focus on Section 8s. Um, and there are different programs too that, kind of are associated with both of those things. So like for a student rental, a lot of people and a lot of lenders don't treat it um, as well as maybe some other lenders. You would probably want to purchase the property vacant and then do whatever you need to do with the property once you actually have full ownership of it. Whereas with a Section 8 rental, you might say, um, there's a rate impact on if you have a Section 8 rental or if you don't have a Section 8 rental. So like these are the things that you kind of need to know up front in order to, kind of make the process as smooth as it possibly can go. Obviously, there's going to be like some hiccups. Hopefully you can mitigate those hiccups, but being transparent up front is probably the best way that somebody like myself can help out a prospective client.
You have one really cool loan that I'm curious if you could speak to a little bit. I'm on the website now, the fix and flip loan. I haven't personally done this with you, but I don't know if you could speak on it a little bit. I mean, up to 90% purchase, 75% ARV, and then it also says 100% of the renovation. Seems like a really lucrative loan, kind of like the Burr process is built into that loan. So I don't know if you could speak on that loan a little bit for us.
Yeah, so that is the front end of the BRRRR strategy, so that buy and renovate aspect of it. So the fix and flip loans have the possibility to be able to put less money down in order to acquire the property. So the loan to cost aspect of it, so you're seeing the 90%, that's obviously the best case scenario. But the initial loan to cost that we can give, and that's going to be associated with essentially a down payment, like they're kind of synonymous with one another. That initial loan to cost is going to be dependent on how many rentals you've got in your portfolio, how many fix and flips or fix and holds you've done, and we're really only looking back 3 years in order to quantify that. And then FICO score, 680 plus is usually what we're looking for. Um, so those experiences coupled with the FICO score is going to determine what kind of leverage that we can give you on the front end. So whether that be 80, 85, 90%, in, best case scenarios. And then the renovation budget, we're always going to finance 100% of it. So we usually keep it in a construction escrow when the loan closes, so that money is there to be used and outlined on a scope of work. So when the loan closes, that money is basically sitting there and it works on like a reimbursement basis. So borrower or client completes a set of work. Let's say in their scope of work, for an example, they have demolition outlined, they have electrical and plumbing, right? They complete all of those items at 100%. We can then send an inspector out to the property and take a look at the stuff that they completed, and then we'll reimburse them for the dollar amount that they spent on the property up to that point. So, like if you have a $40,000 budget and you're asking for, let's say, 15, we'll wire the 15 back to you. You can do this as many times as you want. Obviously, there's a cost incurred to every draw that you do. Um, but that's the initial aspect of the BRRRR strategy. If you plan on holding on to the property after the renovations are done, then we can transition a client into that DSCR loan program through a refinance. Or if they want to flip it, then they ask us for a payoff and they wipe their hands clean and they move on to the next project after selling it. Obviously, they'll just net the proceeds minus the closing costs associated with closing a loan through a realtor and all that fun stuff. Um, but from a fix and flip perspective, going into a property with the least amount of money down is certainly going to be a benefit for the back end, on whatever exit strategy it is that you choose.
There's a ton of value in that as well because you don't have to worry about trying to find the next bank that's going to fund your deal. I got stuck kind of doing a burr with Bank A, and then I couldn't refi out of it, and I struggled to find like a secondary bank. So having kind of an all-in-one process where you can get the renovation started, and then once you're ready to get that second loan, being able to switch into a DSCR with you, it's kind of like a one-stop shop, and I think there's a lot of value in that.
So I'll also piggyback on something like that too, Tom. The biggest one of the biggest mistakes that I see a lot of clients do is they are content with the exit strategy that they originally planned on doing. What I would tell somebody to do, like my tip of advice, is to underwrite the deal from two perspectives. Underwrite the deal as a flip, right? Make sure that your exit sell price is going to make sense to you and the margins that you kind of want when you sell the property, but also underwrite it as a refinance too, because things happen, the market changes every day. Let's say you go a couple of months over on your timeline and the market changes within that 3 to 6 month period. Now I need to keep the property as opposed to my initial plan of selling it. Well, does the property actually make sense from a refinance perspective, or am I already digging myself a hole in order to get into that long-term option so I don't lose money on the transaction? And people do lose money on the transaction too. Like it's not all sunshines and rainbows either. Um, so my tip of advice, at least on that side of things, would be to underwrite it from two perspectives, so firsthand, it's going to work either which way. You need to be okay with both of those options. And then on the flip side too, so I know you mentioned that rehab money and loan to cost and obviously all that stuff is important too. A lot of people tend to go to a privatized lender, so like somebody that has, like, let's say a self-directed IRA, or they have money that's like sitting in a 401k that they want to use, and they do 100% financing on the purchase and then 100% financing on the renovation and all of that stuff. That's all well and good. A lot of people actually acquire very good properties on that perspective of privatized lending, like true private lending. But again, same thing. You need to make sure that the refinance aspect, if you're going to hold on to these properties long term, makes sense so that you're paying off private lender A and you're making money on the transaction, as opposed to just doing rate and term refinances at max leverage because you have to pay off the lender plus get a little bit of money out at closing so that you can make the deal worthwhile. So the initial underwrite on a deal is going to be probably your most important thing before presenting it to a lender such as myself. Um, Obviously, we're going to help you with that aspect too. I'm going to show you both of those options, but always probably good to have a generalized idea of what your game plan is going to be from like a fix and flip perspective. If it's going to be a flip, if it's going to be a refi, whatever the case is. Make sure you kind of know firsthand what you're going into first. Um, and then, I'll kind of just like double down and say like, yes, this is a good idea as a flip, or it's a good idea as a refi, or both, or whatever the case may be. Kind of just be like a helping hand from that side of things too.
Yeah, I feel like the lowest possible percent down is always at a first glance the most appealing, especially when you're first getting into it, because most people don't have a ton of money. But you kind of start to realize like one, the more money that you're borrowing, the more money you're paying interest on. So your margins actually, I mean, you actually like if you do a flip, we'll say, and you put down 0%, you're gonna walk away with less than if you put down 25%, obviously, because you're borrowing an extra 25%.
Right.
So I kind of feel like I would definitely still take the 0% down, but at this point in my life, but I would also want to make sure that I have like the 30% down cash as like a backup in case things go wrong, because as you said, they do. But you said a few things that I have a couple questions, and they kind of piggyback on each other. You are referring to Burr.com as like a private lender. And in my mind, I think of private lender as like my uncle gives me some money or I find people that give me cash or whatever. I think of Burr as more of a hard money lender. Is there a difference in the industry? Like I don't work in lending, but like I think of that as hard money. And then also, are you guys like brokering? So are you getting a loan from a bunch of different banks or are you lending directly?
Yeah, so two good questions. So at least from the start portion of it, hard money and privatized money, I guess, have different definitions to different people. So it is hard to like kind of deviate from both of them. But when I guess use the definitions of privatized money, I mean like, a rich doctor that has, millions in his bank account that needs to use it and sees, oh, somebody wants to invest in real estate. Well, I'll give them a loan at 12% and X amount of points in origination. I'll close it in 5 days and I won't really ask too many questions outside of that. And I'm going to make my money back. From like a hard money lending perspective, it's a little bit more institutionalized where it's going to take 21 to 24 days to close. They're going to ask you the same questions that we might ask you on the DSCR side. Um, it is going to be a little bit more of a process. You're going to get an appraisal done. We're going to get title done. We're going to get insurance done. All of that fun stuff. So that's where I kind of differentiate between both. Now, the secondary question is, if we broker loans or if we're like a in-house option. The truth is we have both. We do have a balance sheet lending perspective that we cycle a lot of our loans to. Now on the flip side, if there's an option that doesn't really work with the in-house option, then I kind of push it to other avenues to say, hey, this is the scenario. Like, can you help me out with getting terms? And I'll give you the general example. The deal that Tom and I did on the property in Shavertown, I told him flat out that I can't do a student rental purchase in-house because it's classified as a single room occupancy style property, and not a lot of lenders typically like to do that. I told him that I do have a broker option where, this other lender does have a program that will allow it to close. And that process wasn't the smoothest, it wasn't the greatest. But with his Shavertown property going through that avenue, and then the other property that we just did in Dallas was our in-house option. It was a lot smoother of a transaction. It was a lot less like tedious questions that were being asked. I know we had some fun with the attorneys and the title and all of that stuff, but I'll save that one for another day. But we tend to make more of the decisions with the in-house credit line as opposed to having to broker out. But just from like a lender perspective, we do have both. And a lot of lenders out there will say that they're direct lenders when in reality they're brokers. That is just the name of the game. However, I do want to make a point of emphasis that no matter if somebody is a broker or a direct lender, I really don't think it matters that much. I think what matters is if the deal is going to close. And if they're a broker and they're not closing the deals, then that's one thing. But if they're brokering the loans and they're closing, then it's not really going to matter all that much because everybody's happy in the transaction. So I guess brokers have like this bad aura, I guess, around them that nobody really wants to work with a broker per se. They'd rather work with somebody that's a little bit more direct in making the decisions. But in that capacity, I don't really see it, as a positive or a negative, either which way. It's really
I
just one
think
closes.
the I could be completely wrong here, but in my mind, and I don't think this is right, but in my mind, brokers usually charge like a 2% like brokerage fee. Whereas if you go straight to like a credit union to get and now I'm talking conventional, but like you go straight to a credit union, you're not going to pay a two points on a loan. DSCR I think is standard to pay 2 points. I don't is does any of that sound right?
Yeah, so I guess it depends too on the scenario too, right? Because there's a difference between an individual broker, so like an individual such as myself that owns and operates our own company and gets leads and brings them to every single lender out there in order to get like the best terms for their specific client. And then there's the brokers from like a lender perspective where they're not lending their own money, they're lending somebody else's money. So there's a difference between those two things. But from the, I guess, origination perspective, which I guess is kind of where you're going with it, I
Yeah.
see brokers that sometimes do charge, origination points on the front end of the HUD. We do because that's how we make our money, is through those origination fees. A lot of our credit lines, they take a processing and legal fee. It's not something that we see. We only see the origination. Um, but other lenders out there, they might charge like let's say like a flat $1,500 underwriting fee or whatever, and maybe they'll make a little bit of money within the rate that they charge somebody too. So
Okay.
there's different, I guess, perspectives of that. But the two
Yeah,
points
my
really,
understanding is that pretty much all DSCR charges points.
yeah, yeah,
I
they're
haven't
going
seen any
to.
that don't.
Yeah, they're going to, whether it's either upfront, like in your face, like here's the origination charge, or it's going to be done in the rate in some capacity. We call it yield spread premium on our end. Um, but from like a, points perspective or whatever, obviously some lenders are going to charge less than others. You might have a lender that charges like 3 points, and then you might have another one that does a point and a half in order to try and earn your business. That is a little bit more typical on the like the lending side, through DSCR and fix and flip and all that stuff.
Cool. I think one benefit of having somebody that deals with loans every day is to ask you a little bit about what the current market is like. I mean, Ty and I always speculate and guess, and like we listen to things periodically, but find that you're more of an expert listening to the rates and like how they impact current loans today. So if that's something you could speak to, what's kind of happening in the current lending market, are rates really dropping? Like you say they're going to drop like 2 to 3 more times before the end of the year. Could you speak a little bit towards that?
Yeah, so I definitely want to start by like debunking a theory that the Fed cutting rates is correlated 100% to what mortgage rates are going to be. That's not true at all. So the Fed can cut a quarter of an interest rate, and people will call us that day and say, "Oh, does that mean that your rates dropped a quarter of a percent?" Like, no, that's not true. Essentially, what the Fed is doing is they're cutting the rate so that you're borrowing less, and it's really more so for like credit cards and auto loans and home loans, and like there's a bunch of things that are looped into like a rate cut, but it's not as quick as like them cutting a rate and then we just cut ours at the same amount or the same time that they cut theirs. So I just wanted to debunk that like just straight away. A lot of our loans, the interest rates are dependent on the 5 and 10 year treasuries. So
Yeah.
there's a way to like truthfully calculate it where you're taking the yield of the 5 year treasury and then you're adding in all of your loan level price adjusters. So kind of what we spoke about earlier, your FICO, your property type, your loan amount, your DSCR and where that falls. There's different calculations for each of those things, and your premium um, on the yield plus like some specific margin plus all of the loan level price adjusters is where your final interest rate is going to be. And I know that's a lot, but there are a lot of things that kind of take place too in order to dictate that rate. And a lot of that stuff too is passed down from the top head honchos of the market. So like the MetLifes, the BlackRocks, they're kind of the ones that are setting that rate. And then everybody that they have underneath them is essentially taking like a little bit of a spread further so that this way the end user is going to have like I don't know, let's say like a 6.5% rate. Well, BlackRock is borrowing it at a 4% rate, so everybody in that chain of command is making a spread on that rate. So the consumer kind of does get like a little screwed because they're not like you can't obviously just go right to BlackRock and say I want the best rate. Like that's not ever going to happen. Um, but that's typically how rates would, kind of be determined. Now, as far as like any kind of cuts, from what I see, at least on the Fed, we're definitely going to get at least two more by the end of the year. Do I think that's a good thing? I think some people think it is. I'm going to be honest. I think that we're kind of just trying to show that we're hiding a recession. That's just my personal opinion. We're doing things a little bit too quickly, and things are not really evening themselves out. The price of homes was skyrocketing for the last, let's call it 18 months, and rates were, staying high, so it was hard for people to get into those properties, which is why you're also seeing a lot of influx of renters too. Um, so at least from that side of things, it might be good that you're seeing these rate drops, but I don't know if the overall picture is great at this current moment. Like, kind of just have to wait it out and see. But from when I started at Burr, our typical interest rate was sitting in the low 8%. And I was selling loans like at the high eights, maybe low nines in some scenarios, which is essentially like a bridge loan, right? Now we're seeing things like slowly make their way down and they're somewhere in the low to mid sixes. So obviously big difference between 2022, 2023 to now. Um, I do see things slowly starting to move in the right direction. Do I ever think that we're going to see 2, 3, maybe 4% interest rates again? I don't think so. I think,
4% DSCR loan sounds
yeah,
amazing.
I
Let's start
think
a company with that. We would blow up for
A hundred
sure.
percent. It's really tough to see the people that closed loans like back in 2021, right before I started, and their rate was like 3.875 or 4.125, whatever the case was. I'm like, you're never gonna touch this. Like I can't even
Yeah.
try and sell you on refinancing or doing anything because you're never going to do anything.
I still
I
get
would
the letters.
advise somebody never to touch that property ever again, too,
I have a 3.3% rate at my old house, and I even now you get the letters. It's like you could pull out money with a refinance. We can get you a rate at like 7.5%, and it's like, all right, dude, I'm gonna go up 4, but I do want to say that yes, the mortgage rates are not 100% correlated to federal fund rate, but they do follow the same trajectory over long period of time. So like yes, they follow the 10-year treasury or 5-year treasury or whatever. But that if you look at a 30-year graph, if we're going to drop rates another 0.5% by the end of the year, yes, mortgages don't just go down 0.5%, but they will follow the same curve. So like people can expect to get lower mortgage rates. We just don't necessarily know when. I mean, it could, I don't know if there's like a usual lag, if it's usually like a month or 3 months. And I know in some cases the next day the mortgage rates go up. Like I've seen that during some of the cuts is like they go up a point 0.1 or whatever, even though there was a cut, but it
yeah.
does generally follow it.
Yeah, and those graphs too, they are correlated more so with conventional loans or like any
Okay.
kind of uh like institutionalized conventional loan too. So like if somebody's looking at the 30-year graph and then they come to us, they're going to say, well, why is your rate maybe a little higher than what the conventional graph is? That's really more so for like if I went to a bank and I was trying to buy my primary residence, like, and that's with like the perfect parameters too, like 20% down, good credit score, the whole 9 yards, like that might be where that rate is going to fall to, but it's a completely different set of parameters when you're adding in, an FHA buyer or a VA buyer or somebody that is only putting down 5% as opposed to 20%. Your rate is obviously going to be different from a conventional side. And then on the flip side too, for somebody like us, like the requirement is going to be 20% down, but it goes back to our initial conversation where if you're buying a rental, your speed is going to make or break the deal. So would you rather pay the extra quarter% higher and not have to get as many documents requested for conventional loan? There's kind of a trade-off there. But yeah, I get where you're going with, the 30-year graph. It's not like exactly correlated, but of course, when rates drop, you're going to see that decline in a period of time. And usually, real estate has ebbs and flows of like let's call it 3 to 4 years, where like the market is really really good, and then it's really really bad. And I think we're in like year six of it being really really good. So nobody really knows where I guess the bubble is going to
Flow.
burst. Yeah, no, nobody knows where that's going to be, and everybody gets a little nervous, but.
So
Um,
you said you were at Burr.com for 3 years now, which might not be enough time to really answer my question, but I'm assuming you've worked with people that have been like loan officers for a long time. People say, at least like listening to podcasts, I was in college at this time, but people say like the heyday of real estate was like pre 2019. Everything just worked. Like everybody made money, Burr's, and then you hear people say Burr's dead. Like I've heard that from a lot. Brandon Turner disagrees, and me and Tommy take everything he says as true. But like, do you happen to know if there's like a decline in people burring in say like 20, basically since you've been there compared to like pre-COVID?
Yeah. I would say like in our business is kind of like a healthy mix, right? So like when I first started it was probably like 50-50, and now I see more people do DSCR stuff more than, like the fix and flip aspect of it. Like they're buying more rent ready properties. And it is very dependent on the investor too, right? Because some people do have a specific strategy that they want to follow from either a fix and flip perspective, where they want to get their hands dirty, they want to get a property that needs a little bit of help and get it up to speed. Then there's the other people that they want to avoid that at all costs and they want that cash flow from day one. So I do see that kind of changing a little bit. There's pros and cons to both strategies, but from like a starting perspective, I've definitely seen more people tip into the DSCR bucket more so than the fix and flip bucket. Um,
Which I think kind of shows that it's just very hard to get a good deal now, where doing a renovation and then pulling out, basically doing a burr, like a full-fledged burr, is more difficult now. And like me and Tommy see it all the time. Like if it was easy to find those deals, we would have done it 100 times by now. I did one in 2022. I got, or maybe 2023, I got half my money back, and I was super excited about that. But like, we're even having trouble finding deals that like pencil out to that. Now we're looking mostly on market, which actually leads me to a question. Do you see whether deals are on market or off market? And is
yeah,
it, can you, can you give like a general percentage of like our investors finding, is it like 50-50, or like, do you happen to
it's
see that
probably
information
like I want to say maybe like 75-25.
on
Um,
versus off market?
Yeah, on market more 75%, but the people that are getting the off market deals, they're obviously working through a realtor that knows somebody that's putting this property up, or they're working through a wholesaler, which is
Yeah.
definitely the big one, um, which is completely different, fun
Yeah.
game that everybody's got to make money on the wholesaling side. Um, So yeah, I definitely see more of these people are buying properties that are, on the MLS and I can find them very easily. But once in a blue moon, I'll, get a request from somebody that's like, hey, I got this deal from a wholesaler and this is the property address. And then you look up the property address and it's like, I don't know what you're looking at. Like, what are we looking at? And like, you locked it up at what price? Like, is that even like right for the area? Like how much is the wholesaler making on this transaction? Like are they scamming you? Like there's a lot of other questions that get asked at least on that side of things too.
Hey Dom, I want to kind of pivot because as much as it's been great learning about Burr and learning about your knowledge, I think you have a really cool personal story as well with like some of the debt payoff structure that you worked through and like wanting to pay off your student loans uber aggressively. And I know you've been interested in real estate personally, not just as helping other people get loans. I know that's something that you've been looking to do or studying a little bit. So I'm just curious, since the last time we spoke, where you've gone on your journey of paying off debt, but then also trying to get an investment property or like where you are right now.
Yeah, so from graduating college, my one big thing, and I don't know if I can like attribute it to like listening to Dave Ramsey or I can listen to like my dad like chirping in my ear saying that like debt is bad. And yeah, you're right. Like some debt is bad. Like credit card debt is obviously not great, but if you own a property and you have to pay it off over X amount of years, like you still getting some sort of like return on the value that you put into the property. So that debt isn't bad. But from when I graduated, I think my dad ingrained it in my head that my student loans needed to be primary option number one. You get rid of these and you're in tip top shape. So that is essentially what I focused on from when I graduated. I was working in a restaurant that's close to my house. I was living at home. I didn't really have too many expenditures either. Now, also too, when I was graduating, it was still like kind of the height of COVID too. So we were getting, those stimulus checks, we were getting unemployment, and then they were started transitioning back into like everyday life. So I was working at the restaurant, but I was taking all of that money and I was essentially stashing it on my student loans. So I think I was making like $1,000 a week doing nothing from the stimulus checks and the unemployment. So I was taking that, let's call it like 750 or 800 bucks of that $1,000 that I was making every week, and I was throwing it on my loans. And they weren't accruing interest because I think at the time they stopped. Um, but I saw it from a perspective of if I pay these off now, then that means I have more to use later on and I don't have as much weighing me down. And I think the big thing from at least like a college graduate perspective is how big of a detriment that your student loans are going to be, like weighing over your head. And I'll give you like another generalized example too. My brother went to Rowan and he had interest rates for his loans at like the 12 and 13%. Like that's impossible to pay back, right? You're going to be paying that back until you're like 75. So my parents helped him out, try to consolidate those, and then he paid my parents back in order to get rid of those loans specifically, like on the higher interest rates. But to me, I was focusing on getting rid of those as quickly as I possibly could. I got rid of all of my student loans. Now, thankfully, Misericordia was a somewhat affordable place to go to school. I only had about, let's call it 35,000 between my undergraduate and my graduate loans. And I got rid of that in probably a little under 2 years, maybe like a year and a half.
There we
Um,
go. Let's hear a debt-free scream, huh? Come on, Dave.
so from that side of things, like I didn't have anything like left hanging over my head. So what was I doing with the money I was making? I was just stashing it away, stashing it away, stashing it away. And then I started working with Burr, and there's like a different side of things too as a 1099 employee that you need to take into consideration as well, where all of your paychecks are not like the taxes don't get taken out. So you need to be mindful of taking let's call it 35% of every paycheck and stashing it away into account and kind of just forgetting about it come tax time. So it was like a different change from like working in a restaurant where you were making a couple $100 a night serving and then taking that money and just throwing it in the bank and just forgetting about it. Now you're making, I guess big people money. You can call it big people money. And then you have a different set of things you need to worry about. But I was taking all of that money and I was stashing it away. Um, and in April, I actually just bought my primary. So thank you. Um, which funny enough, we found off market. Me and my girlfriend bought it together. Found it off market through a realtor who's a buddy of mine's wife. Her her boss's fiance was actually doing a fix and flip on it and bought it like super cheap. Probably bought it for, and it makes me sick saying it because like how much I paid for it and what he paid for it. He bought it for 150. He probably put, call it 85,000 into it, and he sold it to a schmuck like myself for 400. So that money that I saved went into that, but also I'm learning new things about home ownership, about how expensive things are, um, and I guess a different set of responsibilities as well. So like I'll give you another generalized example. I have to get trees taken out in my backyard on Friday.
Oh yeah,
That costs
they're not cheap.
$6,000 to get rid of
Yeah,
trees. Like, I wish I could just do it myself for 1,500, but I can't. So you
yeah,
realize that everything costs something, and you kind of just have to be like financially in tune with what's going on and being good with your money and not spending it on pointless stuff, especially with owning a property. But it's the same thing with investment properties too. So at least on that side of things too, I help my aunt run her rental business. So I guess I'm like a pseudo property manager. She has a rental in Perth Amboy, and then she has an Airbnb down in Cape May. So my brother and I help her property manage at least the Airbnb down in Cape May. So I'm learning a lot from a property management perspective, but I'm also starting to dabble, at least trying to get my feet wet into the areas that I want to kind of put boots on the ground and start investing myself, whether that be long-term holds, a fix and flip, just to get my feet wet in that department, an Airbnb, whatever the case may be. So that is now on the horizon. I got the fun stuff out of the way first. Um, but from this side of it, I think it helped aid me into knowing what I need to look for and things to look out for as well. So from like a number standpoint, I know what is a good deal and what's not a good deal. Um, and then the markets obviously are a big important factor too on like where you're going to get the best return on investment as well. So I think being in this industry has definitely aided on where I can, start at least my investing journey going forward too.
There's so
yeah.
much to unpack there, but I want to congratulate you again for paying off your student loans. That's awesome. And
And the
then just
first
being
house, super
yeah,
exciting.
No,
and
thank
just
you.
being financially like literate and knowing to save your money and save up, to Ty's point, get your first house. Last time we spoke, I know that was a goal of yours. Also commend you too. Like I think more young people should look at buying houses with their girlfriends or significant others and things, and like, or just friends in general. Like I think more and more people should come up with different ways to purchase homes together where it's a lot. I mean, it's tougher, right? Like especially in the New Jersey market, houses are a lot more expensive,
It's
and
brutal.
so it is brutal. But coming up with like outside the way, like coming like you and like your four best friends from Miz or from like high school or something like that, coming together, as long as they're like financially literate as well, like I think there's a lot of value in just partnerships and coming up with partnerships. Like, even if things don't go great down the line, like, you're still going to most likely make money by purchasing the house. And whether you start renting it out or maybe you guys live there, it'll probably be cheaper than paying rent somewhere. And I think more people should look at that. And that led to like one other question I wanted to ask you. When you are doing a lot of these loans, like what is the typical age of a lot of the people that you're working with? Is it typically folks like over 35 or younger, or like what's the age factor?
Yeah, it's a good question. I think at least so from a lending perspective, I can start there. you need to be at least 21 in order to get a loan with us. However, there's a lot of people that do just jump into it like right out of high school. They'll either get their realtor's license or they'll start wholesaling or they'll do like a joint venture on a property or whatever the case may be. As young as like, I don't know, call it 16, 18. So people do get started rather early. Um, but also there's never a bad time, I think, to jump into this stuff either. I've had clients that are 67 and they're doing their first renovation project, and then we also have clients that are, 24 and they have like six under their belt, right? So I don't think there's ever a bad time or a bad age to jump into it. It's really just more so, um, if you're ready, you need to be 100% committed to actually doing this. Like this isn't something that you can like half-ass, right? Um, this does eventually turn into the long game for somebody because a lot of these people transition from their typical 9 to 5s into doing real estate full time. This is their niche. This is their thing. So you kind of have to be 100% in and committed because if you're not, then you're not going to yield the results that you kind of want.
Yeah,
Real estate investing's. Go ahead, sorry.
I feel like you have such a leg up working in the industry, whether that's one just from like the networking portion, like you're meeting investors, you're meeting other loan officers and banks, you're meeting flippers, like you could potentially partner with these people. You're seeing all the numbers, all the areas like you said, but so like working in that as your 9 to 5, I feel like I'm jealous of people that do something real estate related because like I can't really parlay any of my W-2 knowledge into real estate at all or networking. Like I know some people that work in the real estate industry and they're very successful, but they don't do any investing. And I'm like, why? And they're like, I don't feel like dealing with the tenants. And it's like if you have that like I mean, like it's like to me, it feels like a cheat code. Like whether you're a realtor, and yeah, I guess you could say, well, then why don't I just do it? Well, yeah, I mean that's valid, but yeah, I think you're because of the industry being working in the real estate industry, that will allow you to grow much faster than somebody that is an engineer like myself.
No, I think a lot of people too, they tend to transition from your line of work into doing this full time. So like I'll give you an example. I have a client that does a lot of flips um down in South Jersey, but he's a full-time engineer too, and he decided one day like this is what I want to do like full time. I already have 4 rentals under my belt. Like I want to now transition from being an engineer to doing the real estate thing full time. So you see that more often than not that people are moving from their typical 9 to 5, or they're using their 9 to 5 to aid into taking that money and they're putting it into those properties with the overall goal to get rid of the 9 to 5 and eventually just live off the cash flow of all the properties or continuously doing those flips where they're putting no money into these properties. They're having like a lender or an investor or somebody doing that, and they're constantly turning it over where they're doing like a flip a month or 2 flips a month or whatever the case may be, and they're scaling a different business structure than what they were doing before. So at least from I guess your perspective, like you're kind of just on the horizon of I think probably going into that line of work of doing the real estate thing full time. Maybe not right at this second, but I would assume down the line it's probably something that you want to do.
Yeah, I mean that's obviously the goal. I think I think that's most like people that get into real estate investing. I think that most of the time that is their goal, especially young. Like some people may look at it as like a retirement thing, but yeah, obviously that is a goal. I think a couple factors play into like the longer you wait, the more money you make from your job, making it harder to match that that amount. You know, not that you have to match that amount that you currently make, but like obviously you're going to make more as an engineer at 50 than at 30, right? So the longer you wait, it almost makes it harder to leave. Like it's the golden handcuffs that people say, right? Like you're very comfortable, you're getting a decent salary. But yeah, I mean 100% I'm doing just that, and that's taking the money that I make, saving as much as I can and buying real estate with it. But it takes time unless you're, unless you're just churning burrs over and over and over, and you can take like an initial chunk of capital and buy a ton of properties with, which people do. But yeah, it's just all about getting good deals, really, is what would allow you to grow fast enough to do that. I mean, if you had asked me at 23, I would have said I'd be retired at like 28. And then you quickly realize that there are a very few special people that you hear on podcasts that do it, but it's not easy by any means.
Not at all.
I love the call that you made too of like 67-year-olds getting in and trying to get into real estate, and it kind of shows the point that it's never too late to get into real estate, and you're never too young to start learning about it, even if you can't get a loan until you're 21 or like whatever the age requirements might be. And like in Dom's situation, you got your primary residence, but you're stacking by being in this industry, stacking all this real estate investing knowledge, and you're eventually going to start snowballing and like take off quicker than probably most people because you have so much knowledge and experience. And like the one big thing in real estate is like it takes time. It's not super easy. Real estate is expensive. It's not cheap. You can't get into it with like 5 or 10% down. Obviously, you can get a primary. You can house hack, get multifamily. Like that's a semi cheat code, but it's still very difficult. It's not easy, and especially when you have a spouse or a significant other, it becomes a lot harder to try and house hack into a quadplex. Like I'm sure that your girlfriend was not super on board to do that. I know my wife will not do that. Um, but time is key. So like the more time you spend just learning about things that are going to benefit you later on down the road, and like real estate gives you that option. And you might not be able to retire in the 5 years that Ty wanted to from 23 to 28, but if you add like 10 years to that or 15 years to that, you might be able to at 38 or closer to 40. And so that's like the key as to why Ty and I are so passionate about real estate, why we do this podcast, why we have 35 episodes out there. Like we want people to see how great real estate can be over time. It takes time. And like no, everybody wants something that's easy and it's overnight. And it's like, real estate's going to be too tough. Well, like everything is going to be tough. So like choose your heart and then like move forward from there.
Yeah, that's it.
Well, thanks for coming on so much, and congrats on the student loans and the house. And Tommy and I have 2 years left on a balloon loan that we have seller financing, so we'll be probably reaching out because we'll be in need of a DSCR loan in the next year or two. Whenever rates drop low enough that we feel comfortable that it's a good time to go refi that. But yeah, I appreciate your time, and thanks for all the loan knowledge, because loans, there's a lot to unpack there, and it's like one area that I feel like you can listen to hours and hours of podcasts, but you don't really understand it fully until you kind of just jump into it and do it. So it's nice to hear somebody's perspective that actually does it for their job.
Yeah, thank you guys for having me for one. And two, if there's, one thing that I can do, at least from my side of things, is to try and simplify the finance side of it as much as I possibly can in order for people to make at least a informed decision on the best route that they want to go. So I'm hopeful that, a few people that are listening to this maybe call, ask questions, which is definitely something that we want as a company, is people to ask questions. Um, you'll get a truthful answer from us. And we're kind of here to help and support, uh, our clients and our prospective clients in the best way that we possibly can.
And I
Yeah,
can
we'll put
testify to that. Every time that I've reached out to Dom, he's answered every question in a very consultative approach. And so I do appreciate that. And can you just give us some, where can our listeners find you? Like, what's the best spot if they do want to ask you questions? Where can they reach out to you at?
Yeah, so maybe there's a way that we can find a way to plug all of my socials, but Instagram is probably the best way. I do have a personal one and a business one, but if you want the business one, it's Dominic, spelled, the correct way, no K, no E in my name. So Dominic dot Burr, and it's Burr with four R's. That's the one big thing that a lot of people forget is the last R. So they always do Burr with like 3 or
The
2.
most important one.
They always mess it up. So you can find me on there. You can find me on Facebook. And then just as a general plug to, the company itself, Burr_loans on Instagram. You can definitely find us on our website at burr.com. Be 4 R's.
4 R's,
Yes,
because I just
four
did the
R's.
3 R's and I was on some like waterbottlecold.com and I was like,
Very
what the hell
important.
is
There's
this?
four
This
R's. So yeah, Burr_loans on Instagram, TikTok, Facebook, and then Burr.com on the website. Should be able to answer most of the questions on there, but if not, you can certainly give the office a call, and one of us will be happy to help out.
Yeah, and I'll add all your links in the description. So thanks for coming on.
Thanks, guys.
awesome.
Appreciate it.
Give it up for Dom Pizzi. Thanks for coming out. Appreciate
Thank
you.
you.